Welcome to The Explainer. Today, we're going to break down a truly chaotic week in the financial markets. Seriously. While the big indexes looked pretty calm on the surface, underneath it all, two massive forces were basically tearing the market in half.
So to really get a feel for what happened, just listen to this quote that was making the rounds on the NYSE trading floor. It just perfectly captures the fear that was gripping one side of the market. AI wasn't seen as some cool new thing. No, it was framed as an unstoppable, almost existential threat. And that threat? Well, it showed up as a huge wave of new AI product announcements that kicked off a brutal sell-off. It all started with the software as a service industry, or SaaS, in what traders immediately started calling the SAAS-pocalypse.
So what kicked this whole thing off? Well, it was a few new services from the AI company Anthropic, and the fear just spread like wildfire. First, it slammed software platforms. Then it jumped over to financial and legal tech. It even started hitting private credit lenders who, had a lot of exposure to software loans.
I mean, the impact was just immediate and absolutely severe. The main index that tracks all these software companies, the IGV, it just got hammered. It dropped about 10% in a single week. Think about that. A staggering loss driven entirely by this new fear of AI displacement.
But here's the thing. It wasn't just a software problem. This AI wave just kept on rolling. It crashed into wealth management firms, real estate companies, even trucking and logistics. Basically, if an AI was announced for your specific industry, the selling was just boom, fast and wide.
Now this is where it gets really interesting, because the threat suddenly became very, very real to a lot of people. A viral AI-generated video clip, it was a fight scene between Brad Pitt and Tom Cruise. It prompted this super stark warning from the screenwriter of Deadpool. All of a sudden, this wasn't just about code anymore. It was about creativity, it was about media, maybe even the very fabric of Hollywood.
Okay, but here's the crazy twist. While all that carnage was happening in the world of tech, a completely different story was playing out right under the surface. A story of, believe it or not, hidden strength and a massive shift in where the money was going.
So here's the really crucial point. This deep split in the market. Money was literally rushing out of big tech and software stocks. And where did it go? Straight into the old guard, traditional sectors like utilities, materials, and industrials. This whole phenomenon has a name, the Great Rotation.
Now, to really see this rotation happening, you got to understand what an equal weight index is. Think of it like this. The regular S&P 500 is dominated by a few giant tech companies, right? But an equal weight index gives every single company the same importance, big or small. And this week, that perspective showed us something huge. The average company was actually doing pretty darn well.
And wow, does this chart show that rotation in action. I mean, look at utilities. That sector had its best week in a decade, soaring an incredible 7%. So while tech was getting absolutely crushed, these traditionally boring sectors were having a monster rally.
You want to see the trend? Looking at this performance ranking, it's just undeniable. The leaders are all those defensive and cyclical sectors, and the laggards, well, what do you know? They're the exact same groups getting targeted by the AI fear wave. Financials, communication services, and of course, technology.
So you have these two completely different markets going in opposite directions. And what that created was this really strange and, potentially dangerous situation. While the major indexes looked calm, there was incredible turbulence just below the surface.
You are not going to believe this statistic from a Nomura study. The difference in performance between the market's winners and losers, it's called stock dispersion, was in the 99th percentile. That means we have almost never seen individual stocks move this violently in opposite directions in the last 30 years.
And that brings us to the key question of the week. How is this even possible, right? How can the market be total chaos and yet look totally calm on the surface? How can one half be burning down while the other half is thriving and the average just kind of stays flat?
Well, the answer is that great rotation we've been talking about. It's creating this massive, and I mean massive, balancing act. The gains in sectors like utilities and materials were just big enough to cancel out the punishing losses in tech, and that created this total illusion of stability.
So why were these non-tech sectors so strong, so resilient? To figure that out, we've got to take a quick look at the underlying health of the actual economy, because that's what's giving them all their strength.
Okay, so the latest data comes in, and it paints a pretty solid picture. Job growth was strong, unemployment actually fell, and inflation cooled off a bit. All this suggests the real economy is holding up, and that provides a powerful foundation for all those cyclical stocks that are leading the market right now.
Which brings us to where we are now, this fascinating but deeply, deeply unstable equilibrium. You've got a market being pulled in two completely opposite directions by two massive colliding forces.
Think of it like a giant tug-of-war for the soul of the market. On one side, you have the disruptive fear of AI just crushing all the tech darlings, and on the other, you have the resilient strength of these old economy sectors, and they're being powered by a pretty solid economic backdrop.
And that leaves us with the big multi-trillion-dollar question. This balance, it can't last forever. So which powerful force is ultimately going to win out? Is it going to be AI disruption or the great economic rotation? The answer to that is going to define where the market and your money goes from here.